Understand what the economics of the business are likely to look like 10 years from now or 20 years from now. So figuring out the economic characteristics of the winners in a wonderful business is not easy. The easier thing to do is figure out who loses. The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Defining your circle of competence is the most important aspect of investing. Only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do. I understand the economics of it. I understand the competitive aspects of the business. There can be all kinds of companies that have wonderful futures, but I don't know which ones they are. I've given talks in the past where I carry with me a 70-page, tightly printed list, and it shows 2,000 auto companies. Now, if at the start of the 20th century, you had seen what the auto was going to do to this country, the impact it would have on the lives of then your children and grandchildren and so on. And it transformed the American landscape. But of those 2,000 companies, 3 basically survive. And they haven't done that well many times. So how do you pick 3 winners out of 2,000? I mean, it's not so easy to do. It's easy when you look back, but it's not so easy looking forward. So you could have been dead right on the fact that the auto industry, in fact, you probably couldn't have predicted how big an impact it would have. But you wouldn't have, if you bought companies across the board, you wouldn't have made any money because the economic characteristics of that business were not easy to define. I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the auto, is you should have gone short horses. There were 20 million horses in 1900, and there's about 4 million horses now. So it's easy to figure out the losers. The loser is the horse. But the winner was the auto overall. But 2,000 companies just about failed. A few merged out and so on. There were 3 companies, auto companies, in the Dow Industrials in the 1920s and 30s. Studebaker, Nash Kelvinator, and Hudson Motor. Now, those names are all familiar to me, and maybe some of them are familiar to you, but they're not making any cars. They didn't make money. And yet at one time, they were in the Dow 30. They were the aristocrats of American business, and they got creamed. So figuring out the economic characteristics of the winners in a wonderful business is not easy. In North Carolina, Orville and Wilbur took off. Well, I guess Orville took off and Wilbur watched. I'd have been Wilbur. But if you could have seen the future of the airline business from that point forward and how that would transform things, it would have blown you away. And it's excited people, incidentally, ever since. But if there had been a capitalist at Kitty Hawk, he should have shot Orville down. I mean, because it's done nothing but cost investors money. There were over 400 airplane companies in the 1920s and 30s alone. There was in Omaha. There was in Nebraska. We were the Silicon Valley, apparently, of aircraft. And they all disappeared. It's been a terrible business. At the end of 1991, if you'd added up the aggregate earnings from all airline companies with billions poured in, since Wilbur and Orville were down there, they came to less than 0. The number of passengers went up every year. The importance of the industry was dramatically increased decade by decade, and nobody made any money. So figuring out the economic consequences, TV, I think there's, 20, 25 million sets a year sold in the United States. I don't think there's one of them made in the United States anymore. I mean, you'd say TV set manufacturer, what a wonderful business. I mean, everybody, nobody had a TV in 1950. Thereabouts 45 to 50. Everybody has multiple sets now. Nobody in the United States has made any real money making the sets. They're all out of business. The Magnavoxes, the RCAs, all of those companies. Radio was the equivalent of the 20. Over 500 companies making radios in the 1920s. Again, I don't think there's a U.S. radio manufacturer at the present time. But Coca-Cola, what was it, 1884 at Jacobs Pharmacy or whatever, the fellow comes up with something. A lot of copiers over the years. But now you've got a company that is selling roughly 1.1 billion 8-ounce servings of its product, not all Coke, Sprite, and some others, daily throughout the world 117 years later. So understanding the economic characteristics of a business is different than predicting the fact that an industry is going to do wonderfully. So when I look at the internet businesses or I look at tech businesses, I say this is a marvelous thing, and I love to play around on the computer, and now I order my books from Amazon and all kinds of things, but I don't know who's going to win. Unless I know who's going to win, I'm not interested in investing. I'll just play around on the computer. And defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, I'm no genius, he said, but I'm smart in spots, and I stay around those spots. And that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. The question is how much are you going to get, when are you going to get it, and how sure are you? The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, so it makes the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously. And you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground. You're laying out cash now to get more cash back later on. And the question is how much are you going to get? When are you going to get it? And how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally. But the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those.